SpaceX just faced its first Wall Street test, and the result was brutal. Revenue nearly doubled. The quarterly loss was cut almost in half. Starlink subscribers doubled. Every major business produced faster growth, and the company beat Wall Street's revenue forecast by almost $1 billion. Then the stock collapsed. In a single trading session, SpaceX fell almost 14% and erased more than $200 billion of market value. The shares closed near $108, roughly 20% below the initial public offering price and more than 50% below the peak reached only weeks earlier. This was not a failed rocket launch. Starlink did not lose customers. There was no explosion on the launch pad. The number that frightened Wall Street was $18.4 billion. That was SpaceX's capital spending in just one quarter. More than $15.8 billion of it went into artificial intelligence infrastructure. In other words, about 86 cents of every capital dollar was no longer being spent on rockets or satellites. It was being spent on data centers, graphics processors, power systems, and the enormous computing empire created after SpaceX absorbed XII and X. SpaceX reported about $3.5 billion of adjusted operating cash-style earnings, then spent more than 5 times that amount on capital equipment. This is why the market sold the stock even after the company crushed the headline expectations. Investors did not discover that SpaceX was growing too slowly. They discovered that SpaceX may be growing too expensively. For more than 2 decades, Elon Musk could answer almost every SpaceX skeptic with another launch, another landing, or another impossible engineering achievement. Wall Street asks a different question. It does not ask whether a rocket can land on a floating platform. It asks when the money invested in that platform comes back as cash. And the first public report revealed something many shareholders may not have fully understood. SpaceX is no longer simply a rocket company with a satellite internet business. It is now a public financing vehicle for 3 giant ambitions at once: global connectivity, fully reusable space transportation, and frontier artificial intelligence. One of those businesses is already a remarkable cash machine. The other 2 are still consuming extraordinary amounts of capital. The entire investment case depends on whether the cash machine can grow fast enough to fund the moonshots without repeatedly asking shareholders and lenders for more money. Start with the headline results because they really were impressive. Second, quarter revenue reached about $7.8 billion, up 92% from a year earlier and comfortably above the roughly $6.9 billion expected by analysts. The net loss narrowed to $541 million from just over $1 billion. The loss per share was only 9 cents, far better than the market had feared. Adjusted earnings before interest, taxes, depreciation, and amortization rose to roughly $3.5 billion. That sounds like a company rapidly approaching profitability. But adjusted earnings can become dangerously flattering when the business is buying assets that become obsolete quickly. SpaceX's artificial intelligence segment produced about $2.6 billion of revenue and reported more than $1 billion of adjusted earnings. Yet under standard accounting, the same segment lost about $1.3 billion from operations. The difference came largely from adding back almost $1.9 billion of depreciation and more than $500 million of share-based compensation. That difference is not a minor accounting footnote. Depreciation represents the cost of machines that are being consumed over time. In artificial intelligence, the most valuable chips can lose economic value quickly as newer systems arrive. Share-based compensation may not leave the bank account today, but it dilutes the owners of the company. Wall Street looked past the adjusted number and saw the economic bill. The cash flow statement makes the challenge even clearer. During the first 6 months of the year, SpaceX generated about $3.5 billion from operating activities. It spent more than $28 billion purchasing property and equipment. The gap was roughly $25 billion before counting other investments. This does not mean SpaceX is about to run out of money. The initial public offering delivered nearly $86 billion of net proceeds. The company also issued $25 billion of senior notes, and it ended the quarter with more than $93 billion in cash, plus another $6 billion in short-term securities. SpaceX has one of the largest war chests in corporate history. But a war chest is not a business model. If capital spending continues to accelerate, even $100 billion can disappear surprisingly quickly. The market is not worried about whether SpaceX can pay next month's electricity bill. It is worried about whether today's shareholders are financing assets that will ever earn an acceptable return. The strongest reason to believe they might is Starlink. SpaceX calls this its connectivity segment, and it is already the economic engine of the empire. Connectivity revenue reached almost $4.3 billion in the quarter, an increase of 66% from a year earlier. Operating income rose to roughly $1.7 billion. That is an operating margin close to 40%, an extraordinary result for a network still expanding across the planet. Starlink ended the quarter with 12 million subscriber lines, exactly double the total from a year earlier. The business benefits from an advantage no traditional telecommunications company can copy easily. SpaceX builds the rockets, launches the satellites, operates the network, sells the terminals, and controls the software. Every improvement in launch cost can improve the economics of the internet service above it. This vertical integration is the most persuasive part of the SpaceX story. When SpaceX launches its own Starlink satellites, it does not record artificial revenue by charging one division from another. The launch cost becomes part of the satellite asset. The company can fill spare launch capacity, improve the network, and learn from each mission while competitors must negotiate with outside providers. Management believes the next generation of Starlink satellites can deliver roughly 10 times more capacity, while Starship could eventually deploy far more satellites per mission. Combine more capable satellites with much greater launch volume, and the theoretical bandwidth increase becomes enormous. SpaceX also plans to expand direct-to-cell service, competing for part of the revenue now earned by traditional mobile carriers. But theoretical bandwidth is not the same as revenue. Starlink's average monthly revenue per subscriber fell from about $85 to $66 over the past year. Some of that decline reflects expansion into lower-priced international markets and a changing customer mix. It may be a healthy trade if lower prices attract millions of new users. It also shows that subscriber growth does not translate dollar for dollar into revenue growth. The network must continue adding customers while avoiding congestion, regulatory restrictions, spectrum conflicts, and aggressive competition. Dense cities are harder for satellite broadband than rural areas. Direct-to-cell may become a major business, but it must coexist with terrestrial networks, handset limitations, and national regulators. Starlink is a proven winner. The size of its ultimate market is still an assumption. The traditional space business is less profitable than the SpaceX legend might suggest. The space segment generated about $962 million of quarterly revenue, up almost 30%, but it lost more than $500 million from operations. Research and development spending in that segment exceeded $1 billion. That is not necessarily a sign of operational weakness. SpaceX is funding Starship, new launch facilities, spacecraft development, and government programs whose economics may take years to emerge. Internal Starlink missions also create value without appearing as external launch revenue. Yet the result matters because the rocket division cannot currently finance the rest of the empire. It is still a capital project of its own. Starship is the hinge connecting almost every optimistic projection. If it becomes rapidly and fully reusable, SpaceX could reduce the cost of placing mass into orbit, launch larger Starlink satellites, support lunar missions, and eventually deploy computing infrastructure in space. If development is delayed or reuse remains limited, many of those future economics move further away while the spending continues today. That leaves the artificial intelligence segment, the business that transformed this earnings report from a space story into a capital allocation story. SpaceX acquired xAI earlier this year, bringing Grok X advertising and large-scale computing infrastructure under the same corporate roof. In the latest quarter, the artificial intelligence segment generated about $2.6 billion of revenue, more than 3 times the level from a year earlier. Most of that revenue came from artificial intelligence solutions and infrastructure rather than advertising demand. For computing capacity is clearly real. SpaceX increased its installed nameplate computing capacity from roughly 0.4 of a gigawatt to 1.4 gigawatts in a year. Management says new data centers can achieve very short payback periods because frontier laboratories and large technology companies are desperate for capacity. Musk also said the company expects to reach an annualized revenue run rate of more than $100 billion by the end of the year. That claim is the center of the bull case. The latest quarterly revenue implies an annualized rate a little above $30 billion. Reaching $100 billion by December would mean roughly tripling that rate in only a few months. Musk then moved SpaceX's internal target for $1 trillion of annual revenue forward to the year 2030, with what he called a possibility of arriving 1 year earlier. The mathematics are breathtaking. Even if SpaceX reaches a $100 billion run rate at the end of this year, it would still need to increase revenue by roughly 78% a year to reach $1 trillion by 2030. Very few large companies in history have sustained growth anywhere near that pace. The bull argument is that SpaceX is not a normal large company. Starlink can expand into mobile service. Artificial intelligence infrastructure can absorb unprecedented demand. Grok and X can monetize software, subscriptions, and advertising. Starship can create entirely new markets. Vertical integration can reduce costs across all three divisions. If several of these systems reinforce one another, growth could be nonlinear. The bear argument is that combining many enormous opportunities does not eliminate risk. It concentrates risk inside one balance sheet. Starlink's profits can be diverted into artificial intelligence data centers. IPO proceeds raised by the rocket company can finance Grok and ex-shareholders who wanted exposure to the strongest launch and satellite network in the world are now also underwriting a frontier model laboratory. A social media platform and a computing landlord-customer concentration adds another layer of uncertainty. A major infrastructure contract disclosed before the offering could generate more than $1 billion per month after capacity ramps. But the arrangement includes termination rights after an initial period with relatively short notice. During a shortage, customers will sign almost any contract that secures chips. When supply becomes abundant, pricing and contract durability can change quickly. SpaceX also committed to building its artificial intelligence systems around NVIDIA hardware that gives the company access to the strongest current ecosystem, and the announcement helped NVIDIA's shares rise. It also ties an enormous investment program to one supplier and to equipment with a rapid replacement cycle. The faster NVIDIA improves its products, the faster yesterday's data center can become economically old. Then there is the valuation. At roughly $108 per share, SpaceX is still worth around $1.4 trillion. Based on revenue generated during the most recent 12 months, the stock trades at more than 60 times sales. The market is not pricing SpaceX as a good aerospace company or a successful internet provider. It is pricing SpaceX as a future global infrastructure monopoly. That does not automatically make the valuation absurd. A business growing close to 100%, with a 40% operating margin in its strongest segment and access to several giant markets, deserves a premium, but the current price leaves very little room for ordinary execution. A delay in Starship, weaker computing prices, lower Starlink revenue per user, or another funding round can change the return dramatically. This is the difference between a great company and a great stock. A company can change the world and still disappoint shareholders who paid for perfection. SpaceX has already achieved things that once appeared impossible. The question is not whether the engineers are exceptional. The question is how much of their future success is already embedded in a valuation larger than most national stock markets. The share price also faces a technical problem that has nothing to do with rockets or artificial intelligence. The first major post-offering lockup release makes as many as 911 million shares held by employees and early investors eligible for sale on the second full trading day after the earnings report. That is more stock than the roughly 640 million shares initially available to the public. Eligible does not mean sold. Employees may hold their shares, and long-term investors may decide that the decline has already gone too far. But the possible supply is enormous. Some early holders have waited years for liquidity and may want to diversify regardless of the earnings outlook. The approaching release probably contributed to the pressure surrounding the report, and it could create volatility that has little connection to the company's operating performance. This is why the next few quarters matter more than Musk's biggest predictions. The first number to watch is not revenue alone, it is operating cash flow after capital spending. If artificial intelligence revenue accelerates while the cash deficit narrows, the investment thesis becomes much stronger. If revenue rises but capital spending rises even faster, shareholders are buying growth without proof of return. The second number is the artificial intelligence segment's operating result before generous adjustments. Depreciation is especially important because computing equipment has a short economic life. If standard operating losses move toward profit, while data centers remain heavily utilized, Wall Street may accept the spending. If adjusted earnings improve only because more costs are added back, skepticism will grow. The third number is Starlink's revenue, per subscriber. Subscriber growth is spectacular, but the network must prove that expansion into lower-priced markets creates more total profit rather than merely more terminals. Enterprise, aviation, maritime, government, and mobile services may become increasingly important because they can generate more revenue per unit of scarce network capacity. The fourth test is Starship. Investors do not need a city on Mars next quarter. They need evidence that the vehicle is moving toward reliable reuse and economically meaningful deployment. Every successful milestone strengthens Starlink, lunar programs, and the possibility of orbital infrastructure. Every long delay keeps a large portion of the trillion-dollar story trapped inside a presentation. And the final test is discipline. Public shareholders will tolerate bold spending when management explains the expected return, the customer contracts, the funding requirement, and the downside plan. They become nervous when one profitable business quietly subsidizes several unrelated ambitions with no clear limit. So did SpaceX pass its first Wall Street test. Operationally, yes, revenue growth was extraordinary. Starlink proved it is a real and highly profitable business. Artificial intelligence demand produced meaningful sales much faster than many investors expected. The company has enough cash to pursue its strategy for now. Financially, the verdict is much less comfortable. The capital spending is historic. The conventional operating loss remains real. The current valuation assumes execution on a scale almost no company has ever achieved, and a massive block of previously restricted shares is becoming eligible for sale just as the market is questioning the economics. The stock's collapse was not Wall Street declaring that Musk has failed. It was Wall Street changing the terms of the conversation. Before the offering, SpaceX could sell possibility. As a public company, it must sell possibility and prove the return on every dollar used to build it. The first earnings report showed two SpaceX companies living inside the same ticker. One is Starlink, a fast-growing network already producing serious profit. The other is an empire of rockets, artificial intelligence, social media, and data centers, attempting to spend its way into several of the largest markets on Earth and beyond it. If Musk is right, today's capital spending will look small compared with the revenue it creates. If he is wrong, Starlink's cash machine may spend years paying for the most expensive collection of unfinished dreams in corporate history. SpaceX has already beaten gravity. Its first public earnings report proved that beating Wall Street may be the harder launch.